Early on, I was in growth. That was what I did a lot of, and as I was young, and as I grew older, I began to invest in dividend paying stocks, and I found that it really did some things for me personally. One is that it created this environment where my emotions weren't as big,
I
right?
think
So
if you're cutting back on experiences, like if people are asking you to go places and you're saying, no, I need to save money or something like that, I think it's totally not worth it. If you have extra, you have a gap, and you're missing out on experiences with friends and family, it's a real mistake.
Investors, welcome back to the channel for another round here of Masters of the Market. Now, today I am incredibly excited because I have not one but two Masters of the Market back on with me. We have Kevin Burgess, who was recently on with me a couple of weeks ago, and then the Average Joe investor who's back on with me yet again, who was on a few weeks prior. And I'm very excited to have the both of them on. I had an idea that essentially sparked from all of you. So I want to thank all of the viewership out there as well. Now, in building the Masters of the Market series, it's really all about introducing dividend investing to dividend investors, whether you're a beginner or more experienced. And there's no better way to really get the insights of dividend investing than those who have come before us and have been doing a standout job as successful dividend investors. Now, both Kevin and the Average Joe we have on with us have a dividend portfolio that is over $1 million, or at least a net worth over $1 million. They've done so through building out successful dividend investment portfolios. So with that, Kevin, Joe, thank you so much for coming back on with me. And I just want to actually start off by allowing the both of you to share where you currently stand in terms of a net worth in your dividend investment portfolios specifically, as well as how much dividend income you're both bringing in per month.
Kevin, go ahead, Kevin.
yeah, I'll go first. So so my portfolio hasn't changed a lot since the last time I was on, which was a week ago. But it's about 1.3 million, and in terms of the dividend income, it's about 40,000 per year. I don't maximize my dividend yield. I look for companies that are going to continue to, and so I'll have a blend, right? I'll have a blend of higher yielding stocks, but also a blend of higher dividend growth stocks, because in retirement, one of the things we want is income, but I also don't want to sacrifice the future just to receive current income. So you'll notice that my yield is probably in the 3% range overall. So that's kind of where I'm at.
Okay. Well, my dividend portfolio is not as large as Kevin's. Mine right now, it was up to almost 215,000. Now it's back down to about 204,000. And it's a taxable brokerage account with M1, and that's my dividend portfolio. But most of my net worth is in ETFs. And so most of my money is wrapped up in IRA. I kind of split it out. About 800K of my net worth is in IRA, 401k, and about 550 is in cash and dividend portfolio, as well as another Vanguard account that I have. So about 1.35 million is my net worth right now. So I've kind of started later in the game of building a dividend portfolio because I realized I want to have cash flow. Like Kevin's got the 40K. I don't have 40K in dividends generated every year. It's about 10,000 from that 204,000 K dividend portfolio right now from that alone. But of course, I get dividends from the ETFs as well, but it's nowhere near 40K. So
Sure. You're well on your way. I can definitely assure everyone that. The next question I want to roll right into, again, for our very first series here with the both of you on with me, is more along the lines of your why dividend investing here, because I think we have a lot of investors who are out there who are looking to jump into the market, of course, make money quickly. And both of your stories actually very similarly, right? You guys both found your way into dividend investing. And of course, it's getting rich on a little bit slower of a path, if you will, instead of growth investing. So what was it about dividend investing specifically that pulled you in? And would you have changed anything looking back at where you stand right now? Would you have changed anything, gotten in earlier, started with growth investing? I guess, Joe, we'll start off with you first for this one.
That's a great question. I think I wish I would have started earlier with the dividend portion, but I'd also do the growth as well. But I'd probably reserve the growth for the IRA, like deferred taxable investments first, even though that sounds backwards. But for someone like me, I don't want to work much longer in the corporate world. So I want cash flow before I'm 59 and a half years old. So, but if you're someone who wants to wait to retire later, then you should just go growth 100%.
Yeah, and similar for me. I think early on, I was in growth. That was what I did a lot of, and as I was young, and as I grew older, I began to invest in dividend paying stocks, and I found that it really did some things for me personally. One is that it created an environment where my emotions weren't as big, right? So, when a dividend stock shoots up, you're sitting there going, should I sell it? What should I do with this? You've got all this emotion built up around a stock. And when you've got a dividend growth stock, and then let's say it shoots up in value, you still have the same question, but you know that every quarter you're getting that dividend payment, and it's just not as I guess front of mind about selling that stock, because it is a stock that is continually paying cash. And so I think that's one of the things for me that kind of drew me toward dividend investing. And so, now I've got, a lot of dividend paying stocks. And also, I think I shared this on the last video, but for me, you can do a lot of things with accounting to fudge the numbers, but there's very little you can do if you don't have cash, right? As a company.
Mhm.
So the company needs cash to pay dividends, and so that gives me a lot of comfort in the way the business is run. And so that's kind of why I gravitated toward and now am heavily invested in dividend paying stocks.
And
Sure.
one more thing I'd like to add is when you go through market downturns and things like that, it really makes you think. Because if you do retire or you want to draw down on, say, your growth stocks, you got to sell them, and you may have to sell them at half their cost or what they were, because the market, as we've seen, it can go down quickly. Like just with COVID, it was down 30% ish, and back in 2008, 2009, we're down 50+% if you're in index funds. So that really made me think of, hey, I don't want to have to worry about or have to, if we do go through a big downturn, that maybe I have to push my retirement off or work. So with dividends, those dividends will keep coming in regardless of those big market dips. And that's one of the things that really sold me. And
Sure.
like Kevin said, is cash flow. Yeah, that's the most important thing. Cash is king there.
So I want to double down on that, because even like right now, Joe, to your point, the market can kind of fluctuate at any given point in time with, what's going on a macro level, right? And you never know what world events are going to happen. Speaking of which, in the last few days, right, anything can just break out, and all of a sudden the market's landscape is changed. My question for both of you here, and we can just popcorn this one, in terms of building like a comfort for being in uncertainty or fear, what has helped the both of you along your investing careers to build a level of comfortability in such uncertain environments?
Well, I'll go first on this one. I don't know how old Joe is, but I think he's younger than me. But I've dealt with really three major drops in the market. One was in the year 2000 with the dot-com bubble. And then also, and as Joe mentioned earlier, in 2008, 2009 with the great financial crisis, and then in 2020 with COVID. So there's been, these big moves in the market. And I guess for me, it's every time that happens, and then there's a lot of little ones in between there, but those are the big ones, right? So every time those kinds of moves happen, it just reinforces that we should be investing during those times. And, you know, we're at a time, I believe, where 10 years from now, 15 years from now, we will kick ourselves if we haven't been investing during this period. Doesn't mean we can't keep some cash on the sideline, but if you're pulling all your cash out, I think in 15 years, you're going to be really sad that you did that. So that's kind of my take on it.
Yeah, my take is really similar to Kevin's, and I turned 50 this year, so I'm not a young guy, but I know I may look a little bit younger, but yeah, I've also been through the same downturns, Y2K and 2008, 2009, as well as COVID. And what when you go through those periods too, it's really tough because it feels like you need to do something. You need to change something in your portfolio, and and you can really hurt yourself. And I did back in 2008, 2009. I moved most of my 401k at the time to bonds, or like cash and bonds. It was like the worst thing. And it took me like a couple years before I realized, oh, I should move that back to stocks. So I probably lost out on a lot of gains. And when the market's plummeting, that's when you need to be investing all the time in the market. I think you should set up weekly, bi-weekly, monthly, whatever it is, and don't change your system. Just keep doing it, and you'll thank yourself later.
Does it matter that, like, you know, for example, should we be planning out weekly, or, you know, bi-weekly, bi-monthly, whatever it is, and just, you know, executing trades no matter the landscape of the market? Because I see it all the time, you know, people trying to time the market, and we all know, right, you should never try to time the market. But to that end, I feel like to invest when the market's so high at points in time, so like a couple months back, right? Like people were throwing all this money into tech stocks, and, you know, I'm like, I was watching Nvidia and people were just throwing money in Nvidia. How would you guys both come at it, you know, through the lens of investing at the right time or in the right stocks? Like, how do we navigate that?
Yeah, I can just share with you what I did, and that is that I just consistently invested every paycheck throughout my entire career. And I did that because I didn't know what tomorrow was going to be in the market. I mean, the thing that is important to understand about the market is most of the moves, the big moves in the market, happen off hours, because that's when companies are required to share information. It is rare that a company will share a big piece of information during market hours. So that's why all the earnings are after market close or before market open. Every time they give earnings, is they can't unless there is some real issue that requires them to do it within the market time. They have to do it outside the market. So guess what? You know, market closes, stock's at $100, and in the morning, great news, but it opens at 150. So I missed the opportunity to buy that stock, right? So if I'm buying consistently all along, and and unfortunately that works the other way as well, but you know, that's just par for the course, right? But if I'm invested, then I get to catch those major upturns in the market. So you know, and even now, just to share a little bit about my dividend portfolio, I have some of my portfolio that is set for the future, and I have those stocks on an automatic reinvestment plan. So anytime a dividend comes in, it buys those shares, whatever amount of shares I can get with that dividend, it buys that automatically. So I'm buying regardless of what's going on in the macro economy, regardless of what's going on with the company. It's just buying shares every time. Now, there's a portion of my portfolio that I don't do that with. That's the portion that I use for cash if I need it, right? So that cash comes into my account. And if I don't need that, then I get to pick which stock I reinvest that in. But I do reinvest. I do keep a bit of cash on the side. I think I have around 5% cash at the moment. But you know, I've had higher than that, but currently I'm at 5%. So you never know what's going to happen. So having some cash on the sidelines, not a bad thing, but don't make it a big amount.
It almost sounds like this. Like, is there such thing as over evaluation?
Way I do it is I have my 3 intersection highways, which I did a video on, but one of those is valuation. And if a stock for me is really highly valued on the market, then of course I do have these reinvested dividends every quarter. That's not, going to move the needle. But I don't invest in stocks that are really high in valuation. I look for those that are lower in valuation, companies that I love, right? Companies I believe in. I believe in their management. I believe in their products. I believe in their strategy. And it's those that are undervalued that I want to be investing in. And so that's the way I do it is I take whatever cash I have outside of these automatic reinvesting things. And I'll share another point here in a second, but then I look for the most undervalued and highly rated from my perspective. And then that's what I will invest in. I was going to share a point and now I've forgotten what it was. But anyway, that's when you get old, that happens.
Yeah, I'll piggyback on Kevin. I do a lot of automation with my investing. With, if you have a 401k, you're putting a certain percentage in of your paycheck automatically, and I kind of invest the same way, where every Monday, just with the dividend portfolio, I do $100 every week, and then it's auto invested based upon what's in my portfolio. Sometimes I do select a stock here or there, but I try to take as much emotion out of it as possible and just automate everything and just kind of dollar cost average into things. And going back to like valuations, I've heard people say Costco was overvalued when I bought it years ago. Same with Apple, same with Microsoft, but they've been really good. I've had really good returns with them. Same with Nvidia. I've tripled my money with it, and I haven't held it for that long. It's been maybe a year or a year and a half-ish, and it's done that. It's been crazy. So maybe it's overvalued now, maybe it isn't. It could, who knows? We don't know what it could do. So
that's almost as scary. Like maybe it's overvalued, maybe it's not.
right.
I'll be honest. I sat with a colleague, and she was buying Nvidia at like almost like maybe like 5% lower than where it is right now. I don't know, maybe 3-4% where it is now. And I was like, I would never touch this stock. It's like it's way too high. Should I be almost reevaluating my investment approach off of that standpoint? Like you said, you don't really know. So what should you kind of gravitate towards to get more in the know or become more certain, I guess? Because being a younger guy, I am the youngest guy on this call, right? So I don't want to make these types of mistakes if I'm looking at, a Costco or the Coca-Cola or the Nvidia. Like I want to know as much as I can. Do I just shoot for quality?
Yeah, like
So
Kevin's. Go ahead, Kevin.
yeah. From my perspective, I think quality is important, right? So when I talk about having undervalued stocks, it's not stocks that I believe are. And let me give an example, so we're not talking generalities. Let's look at 3M, right? Or even Walgreens Boots Alliance, right? So those are companies that are struggling. Now, 3M's got its lawsuit that it's struggling with, but it's struggling in general just because it is not growing its product line. It's got some great products, but it doesn't have a really high trajectory of growth in the future. So, both of those companies are struggling, and therefore, just because they're cheap, people are buying them sometimes. And I don't buy stocks just because they're cheap. I buy stocks that I like at what I consider fair or under valuation. I'm not looking for stocks that are just cheap, right? And so I think that's an important point when you're building your dividend portfolio, is that you don't want to look for the cheap stocks, because most of the time, if not all the time, they're cheap for a reason. And you have to understand the reason, and you have to make sure you're comfortable with the risk of whatever caused them to be cheap to begin with. So that's the way I would approach it.
Sure.
Yeah, I'd agree. I just look for companies that I can see are going to be successful growing 10, 20 years from now. And like Kevin said, you better be intimate with the company financials as well, just so you know what's on their balance sheet.
Is there a way you guys would offer, you know, to all of us that is like a means, right, to find those quality stocks, to avoid the 3Ms, right? Almost these dividend traps, if you will, just because they're cheap. Some people I've seen, right, like YouTubers out there, some people just go by like 52-week lows, which is actually really scary for me when I see that, right? I'll see a video that just says 52-week low stocks, buy now. You know, could you guys share with us maybe a tip or a trick that you've used throughout the years that has helped aid in finding the successful, more quality stocks?
Yeah, well, from my perspective, what I look at is I've got a 5-step process that I go through for every stock. And the first one is the financials. And if I look at the financials and I don't like the financials, then I'm done. I don't have to do any more work. But then I also look at their capital allocation, right? So if I like the financials, I want to then see how they're allocating their capital. They can allocate their capital to either buying back shares or paying dividends or building new factories or, investing in equipment. So I want to see how they're allocating the excess capital that they have. The third thing is I look at the valuation. So if I like the financials and I like the way they're allocating their funds, then I look at the valuation of the company. And valuation is not a precise science. And so there's a lot of people who will invest a lot of time and valuation, and they will, tweak their models. And at the end of the day, it's not an exact science. You just want to know that you're in the vicinity of where the value of the company is. And I think it was Warren Buffett that said, I'd rather pay a fair price for a great company than to pay a cheap price for a good company, right? So, or something like that. He will probably sue me for butchering his quote, but it's something like that. So, when I'm looking at it, I'm looking for the financials, I'm looking for capital allocation, I'm looking for valuation. And if I like all of that, then a lot of people will stop there and they will invest in the stock. But I have 2 more things that I look for. One is I try to understand the strategy and the market place of the business, what kind of products they offer and or service, and how they fit in their environment. So I look at that and I want to make sure I understand their strategy. And the strategy for me is not what they're going to do, but how they're going to make money. And if I can understand that and it makes sense to me, then the 5th thing I look at is the management team. So if they got a good strategy, do they have the people who can really twist that and execute that strategy and gain the most value for me in the future? Because I know as a dividend growth investor, I'm not buying the past, I'm buying the future. And so I want a team in place that's going to be able to give that to me. So those are the 5 things I look at, Ari. And so when I think about valuation, it is one of the 5 pillars. And I also realize that valuation can be what it is. And so I basically subscribe to a service that tells me what it believes the valuation is. I'll compare it to a couple of other things, but I don't get real tied up in that. If I believe the financials are good, capital allocation is good, and the valuation's in an appropriate area, then I move on with my analysis. That's the way I look at it.
Sure.
Yeah, my way is very similar. I just look at things like Kevin had mentioned, like PE ratios, like the payout ratio, the dividend increase, like the last 5 years. Check that out and see how long their dividend streak is as well. And just looking at their balance sheet, are they profitable? Are they growing their profits? And how safe is that dividend? And of course, you can see that with the payout ratio, among other things. But that's what I look for, is growth and safety, and for the future, something I can hold on to and not just make a quick buck on.
Sure. Perhaps I jumped the gun because I want to go back a little bit and actually talk about what are then the steps to getting to like the starting line to start to invest into these companies. And then, we'll talk a little bit about what platforms you guys use to do some of this research, because even there I'm curious. But what are some of the building blocks that you would say, like one or two building blocks that really was successful for you in building an investment foundation, the steps you took prior to investing?
Sure. I made sure I had a solid foundation of ETFs, index funds, so I was well diversified. To me, that was kind of like the guardrails of my choices was to have a substantial amount of index funds in case I pick wrong and pick a lot wrong. So far though, what I have been invested in is paced pretty much the S&P 500, maybe a little bit better. So, but
Sure. Almost like a security foundation laid. Did you ever sell out?
yeah.
You still hold those same ETFs that you initially invested into?
Oh yeah. VTI, VTSAX. I own both of those in an IRA and taxable.
Sure.
So, and
Sure.
401k as well. So I also have VXUS, which is a Vanguard Total Stock Market International, and I own a lot of SCHD, which is if you want to become a dividend investor and not do stock picking, that may be a good option.
Sure. And Kevin, what about you? Some of the building blocks, initial building blocks.
Yeah, I think to come at it, I agree with everything Joe said. To come at it maybe from a different perspective is one of the first things that I did that gave me comfort to invest is actually getting my budget in line, my household budget. And so, if you're thinking about, if you're new to investing and you're thinking about, how do I get into this process? I think if you don't have a household budget that you can live with and be consistent investing from. So, if your household budget says I need X amount of dollars and you have X plus 200, right? Then you take that 200 and you invest it, but you got to be comfortable that you can live on X, right? And so otherwise you're going to be pulling from your investments and probably at the most inopportune times. And so it's really important to have a dependable foundation financially to be able to invest from. So, a household budget, I know it sounds like, really boring, but it's really freeing when you think about it, because you build a budget and you know what you can spend money on. You've given yourself permission to spend money through your budget. And if something comes up that's outside of that, then you haven't given yourself permission to spend that. And if you're going to spend it, you need to decide, what am I not going to spend, right? So you can live within that budget. So, but I also agree with Joe about ETFs. I have about, I guess, 29% of my portfolio or so is ETFs, and mainly the S&P 500. I invest in the ETF VOO, which is VOO in my world. And that gives me a lot of diversification, so much so that I'm, thinking about actually reducing, and I have actually reduced a couple of my positions since our last talk, Ari. And so, I'm looking at, I've bought this farm in Alabama. We are raising chickens. I've got bees. We're remodeling a house. And I'm going, where's the time going to come from to research the 37 companies that I have in my portfolio? So I'm looking at pulling that down. I think I'm down around 34 now. I've gotten rid of 3 companies. So I'm trying to manage my time a little better as
I was
well.
just gonna say, just you were on the other week, you had the 37, now you're down 34.
Down 34.
We'll get you back on next week for the next time we round up all 3 of us, and we'll be at 30.
Yeah.
I'm also trimming my portfolio as well. There's 5 companies that I'm thinking about removing as well. And just to piggyback on the whole budgeting thing, I do videos on, it's not so much budgeting as spend tracking is what I do. Is I just list out everything I spent money on, every dollar. And I also track also my non W2 income and try to, see how close I am to being able to pull the trigger and be financial, for fire possibly, who knows. But I think it's really important to see that you can see where you're leaking money and maybe where you can improve it. Because I've tried to budget and create buckets like spending buckets for food or whatever, it never works out. It's just, I just track it and then I evaluate, hey, I need to fix this. I need to reduce my spending here. And then the next month we'll see if I can do it. That's how I budget. And it's really important because you
Is
have to
it,
have a gap. No gap, you can't build, you can't invest it and, build up a big portfolio. So
I know I started off when it came to a budget, it was the 50, 30, 20 budget, super simple budget that I started off with. And I want to, ask, what budgets did you both first start off with? Joe, I know you just mentioned you just listed, what you bought. I also did that before I started the 50, 30, 20 budget to understand like kind of what I was buying, like where my money was even going. That helped me tremendously. Is there, do you think when it comes to a budget, a point in a time when you're being too restrictive? Like
yeah.
when is it too much?
I think if you're cutting back on experiences, like if people are asking you to go places and you're saying, no, I need to save money or something like that, I think it's totally not worth it. If you have extra, you have a gap and you're missing out on experiences with friends and family, it's a real mistake. So
I almost got to call my girlfriend now and say, babe, we're we're making a mistake.
yeah, dinner's on. Yeah, go out, have fun, do it. Yeah, you only live once. I mean, to a certain extent, as long as as long as you have that gap, you're fine.
Sure. Kevin, anything there?
Yeah, when I mean, I've been budgeting for a long, long time. I would say 99 is when I got really serious about budgeting, and I've changed the approach over the years. I started out with something called Quicken. I don't even know if they make that anymore. It's the old well, it was made by Intuit, right? It was the personalized financial. I think they changed that into like Mint or something like that now, but in 2016, I switched over to an app that's called You Need a Budget. It's YNAB for short. And the approach is a little different. It basically is like the envelope system where you say, I'm going to put so much of my cash that I have on hand, not what's coming in. It doesn't let you budget what's coming in. It only allows you to budget what you have. And so it really has been helpful to me because if I spend money, I have to have the cash. The
Sure.
cash can't be coming in, it has to already be in, right? And so it's a really fascinating approach. At least for me, it's worked very well. And, I think it's just important. Joe made a great point, right, about the way he budgets and the way I budget is different. And the best budgeting tool that you can have is the one that works for you.
Mhm.
It is
Good.
not, this app versus that app versus this approach or that approach. It's about what makes sense to you and what you're going to be able to follow, because that's the one that's going to work and that's the one that's going to make you successful, even if you make it up yourself. So those would be my advice on budgeting.
Mhm.
Sure. No, look, it's key. It sounds like a budget is your first go-to step before getting to investing. What stock platforms, stock research platforms, or websites have you used as you started to dabble into the world of investing that really helped you, or that's helping you today?
I've used a whole bunch of them, but right now Seeking Alpha is where I pull most of my information from.
Sure. Kevin, you're also seeking alpha, or
No, I mean, I have Seeking Alpha or I've had Seeking Alpha in the past, and the ones that I've gravitated toward are in terms of just research is and they're all paid apps. So unfortunately, the one that I probably go to the most is Morningstar. And the reason I go there the most is because that's where my portfolio is loaded. And so I get to see my portfolio, but it also gives me what their perspective on valuation is. It gives me their analysis around each individual stock. So I get a lot of good insight from that. It doesn't give me answers, it just gives me insight. Then the other program that I use is called Simply Safe Dividends. It's program that they're people, it's not algorithms, right? It's actually physical people who are looking at companies and using their own scale. And I don't get too tied up in whether it's a 65 or a 67 in terms of numbers. What they have, these major categories like, very safe, unsafe. Those are the categories that I really look at. How do they look at it overall? So I have Morningstar, Simply Safe Dividends, and I use Fast Graphs, the medium version. I don't have the top version. Just periodically when I'm looking at trends and history and where it is compared to where it's traded in the past and that kind of thing. Those are the three apps that I use a lot.
Sure. Would you say that these investing apps really helped you, tremendously, or were they just kind of some icing on the cake that has helped you along the way with some tidbits of information? Because, throughout my investing career, to be honest, I never purchased any platform. I never paid for anything. So I'm curious to know, like, is it necessary? Are these platforms really necessary for us to begin? Perhaps after we make that initial ETF investment, we start to look for individual stocks. Do we need these platforms?
That's a good question.
Yeah.
Right now, I'm
I
not
would,
paying for a platform right now. So, but I don't think it would hurt to have that extra information.
Sure.
yeah, the beauty of Seeking Alpha is they have a great free program. I mean, they give you a lot of data in their free program, and so that's a great app to have. I would say the answer is no. You don't need any of them. I mean, you can use an Excel spreadsheet or even Google Sheets, right, to load your portfolio in. You can go to if you want to research, let's say, one or two stocks, go to their website and pull down their 10Qs and their 10Ks and their presentations to the investing community, and just read through that stuff, and decide what data makes sense and pull it from there. I think that's a very fine way to do it. It takes time, right? So where I am in my life, Joe made a great point, when we're budgeting, we don't want to give up on life experiences. Well, I don't want to spend my life pulling numbers out of 10Qs and 10Ks. And my portfolio is large enough to support paying for some of these apps. And so I've made the choice to pay for these apps to give me the information already chewed up, already digested. And so it shows me their payout ratio without me having to calculate it. It shows me with their return on invested capital. So I get all of these metrics that I don't have to calculate out of their financial statements. So it gives me that, that ability to spend more time with my family and less time just pulling data together. I'd rather spend more time analyzing a stock than pulling the data.
Sure. I'm laughing to myself because I'm almost like it wasn't in my budget. These apps. I'll throw this one out to the both of you. We'll popcorn this question as well. What sites could they use? Where could we go? Seeking Alpha, I know, has a free option out there. Some people are using Google. Are there any traps that are out there that we should look out for, at least with these sites, or is it pretty standard, like safe for us investors without any paid software to find information?
But I guess if you're new, it's hard to know what's really reputable. If you're just using what pops up first in your Google search, that may not be the most reputable. I don't know. But
yeah, look, the reason I ask is that I've spoken to a fair amount of investors who, like, I know in my shoes, right? It was like, I'm going to find good companies, quality companies, typically companies that I'm using their products and invest into them, or, look into these companies, right? And then make the next steps to invest. But I do know a fair amount of investors who are out there who there's a fear to get invested because now there's like this added layer of, well, I need to have an investment research platform. That's going to cost me money. I don't have the money for that. So of course, we all want as much certainty as we get. Like, I want to get your takes on, say, like a Motley Fool, where these are it's a paid platform. They've done a standout job with Motley Fool, but I don't know if you guys have seen the prices on it. It's like astronomical, and they will give you essentially your stock picks. Buy this stock now. both of you say in terms of buying a platform like that, where someone's just feeding you the stocks to buy?
I wouldn't do it because I dollar cost average into just good companies is
Sure.
what I do. So for me, they're probably going to identify a growth company I've probably never heard of or know little about, and I'm just putting all my eggs in that basket. I don't believe in it. I'd rather be sure in it myself, because what could happen is if Motley Fool gives me a tip, I follow it and I don't know why, and then the stock drops 50%, I'm going to probably sell it because I won't know anything about it. The more I know about it, like say Coca-Cola dropping now, I'm not panicked at all. It could drop some more. I'll buy some more. It's fine because I know a lot more about it. It doesn't scare me. So I think an investor who's new and doesn't know anything about the company is just given a tip. They're just going to sell it, and they're going to lose uh, in the long run. So I wouldn't recommend it.
Yeah, I think that's spot on. I mean, if you think about it, if you want to pay someone to tell you when and what stock to buy, what and when stock to when to buy a stock, then you're really not an investor, right? You're just wanting someone to tell you what to do. So I would, and they're not going to be right as often as you think. And so I would say that if you're not interested in doing your own research and your own due diligence, just stay with ETFs, right? Just get an ETF. You're diversified. You can, they'll pick those stocks for you, and you're basically putting money into an ETF, and I think that would be great. But yeah, if you don't, I like the way Joe said it. If you don't know why you're investing in something, then you're on thin ice. There's a lot of risk there. And if you're looking for ideas, there's a lot of ideas all over. There's a lot of services that just say, oh, the top 3 dividends. I mean, there's a lot of videos out on YouTube that say, and so I listen to those and I listen for ideas, but it doesn't mean that I'm not going to send them through my 5-step process, right? So I may come up
Exactly.
with 3 or 4 ideas, but then I've got to run my own due diligence on them. And if I like them, then I can put them on my watch list. And if I don't, they leave. So
Yep, I do the same. And a lot of times the stocks that people are saying this is a great time to buy X stock. A lot of times that's what my M1 just it's automatically buying it because it's a stock in my portfolio that's dropped, and it's lower. It's lower in my allocation, so I have to bring it back up, and it's just automatically buying it. So a lot of times it's the same stocks that people are pushing, and they're good people. These people know what they're talking about too. I respect them. It's the same ones oftentimes that I'm buying anyway.
Sure.
So
yeah.
Sure. You mentioned M1. It begs the question, what brokerages should we get started with?
God, it's personal preference. I think if you're new to it and really know nothing about stock investing, and I wouldn't start with Robinhood. I've heard bad things, and M1 is really the interface, and the mobile app is really neat. It's really easy to use, but I know a lot of people will recommend like Vanguard, Schwab, and Fidelity. Those are like the big 3 as far as the big stock brokerages. But I use Vanguard myself for IRA as well as a taxable account, and M1, that's where I'm invested. Use T Rowe for 401k. So I like them all.
Yeah, I don't think there's really any preference from my perspective. I think I know a lot of people that use M1. I've never had an M1 account. My account is at Fidelity. I also have a Schwab account, but I have I think 1 penny in that brokerage, and the reason is I had what was it, Scott Trade from years ago, that brokerage Scott Trade, and I shifted everything over to Fidelity, but I didn't do it right, and I left 1 penny in the account, and that account has been open ever since with that 1 penny. It went from Scott Trade to TD Ameritrade, now to Charles Schwab, and it's still got 1 penny in it. So.
I thought you were going to say it compounded maybe an interest. And that 1 penny turned
Maybe
into
a penny and a
10,000.
half now.
Yeah.
Oh, that's great. That's
Hopefully
great.
you're paperless with that account, right?
It is definitely.
If I driving crazy with the postage.
Oh, no doubt.
You're paying more on it than you're getting from it.
Yeah.
So brokerage account wise, personal preference, that is great to know. I started off with Vanguard myself. I've been a Vanguard guy. I haven't strayed away. I thought about actually opening up a Robinhood account. I got really bored after I had $100,000, and I go, do I maybe make a Robinhood account to show YouTube again how to build the account again? I haven't yet to do it, but I don't think I will. But so I want to wrap up here. We've learned a lot throughout this first session with our two masters of the market who are on with us. And, at least I've taken away some key points for those newer beginner investors out there. First and foremost, start with the budget, get your money right, manage your money before you start to invest into the stock market. And my second biggest takeaway here is actually one which I'm in a similar boat to both of you gentlemen, which is build a foundation, get yourself an investment foundation, and do that with an ETF because you can't lose. And last but not least, keep 1 penny in a brokerage account. So what I want to wrap up with for this session at least is actually I want to take it a little bit more in a personalized direction because we often talk, especially on YouTube, right? Like about all of the clout, our successes. Here's all the success. And to be honest, I even myself can be on with you both. And I know you have investment portfolios, right? And net worths that are over, $1 million. And for a lot of us, I could be looking at that and saying, well, I'm only at, 200 and 200 and something thousand, and I'll never get there. I'm not Kevin. I'm not Joe. So I'll just leave it to those guys. I'd love to know a couple of your failures along the way, things that, perhaps have just maybe almost made you deviate away from investing, but you stayed on the course here with the longer term in mind, just so we can all see that investing is full of many ups, but also many downs. And Kevin, I guess I'll pass this one off to you first.
Well, thanks. There's I think from just thinking back through history for me, we started out as with we got married in 1987, and then we had our first child in 1990, and my wife had a desire to stay at home and take care of our family, and so she was actually making more money than I was. And so it was really a big decision to now live on 45% of what we were making, right? So, then fast forward, my career began to take off, and I began to make more money, became more valuable in the marketplace. And then around 99, my salary doubled. And so, I was able then to really crank down and start investing. But 99 is the year before the year 2000. And so I had some investments and they didn't do very well in the year 2000. So that was a time period for me that was really, I really had to do some soul searching. I'm not very good at this, was the conclusion I made, right? I don't know how to invest very well, but what I didn't, it took me a long time to see was that it was not me, it was the market, right? I mean, things happened, and so what was most important was to stay invested. So that's hard to hear when the market's like pinning you down on the ground, but at some point you'll realize that you're going to get back up and to just keep pouring money in there, keep doing your investing. So that's the example I would give.
Fantastic. Stay in the game. That's what I got from that. Just stay in the game.
Yeah. And this doesn't deal with stock investing, just some challenges I've had along the way. One was I tried my hand at real estate investing and it didn't go so well. I bought a smaller house and it was kind of it was a lower priced home. So the clientele, we're going to have the best credit no matter what I did. And I had challenges kind of keeping keeping it occupied, and I had vacancies. I had to evict some people. So all in all, I lost probably on that house, probably about $15,000 easily, and a lot of my time, because when I bought the home, I had to fix it up. And this was in 2007. And we all know what happened with the Great Recession. So I bought pretty much at the top of the market, this house that needed work. And then I ended up selling it in 2011 at a loss. And also with the court fees, things like that. It was a house. It was a good learning experience. I figured out that being a landlord was it was not for me. And then another challenge I faced, well, just recently, just about a year and a half ago, I got divorced. So I saw my net worth chopped in half. But the good thing was about that was I married well in a sense of we were both great with money. So but my net worth was chopped in half there. So, but I'm still doing quite well, probably very enviable. My situation is to most people would think. So, all in all, even some challenges like not being successful in real estate and having a marriage fail, still doing great financially. So.
I was almost about to take my pen for some relational suggestions. Good with money. No, it's incredibly
well,
important.
I would ask Kevin. Kevin's still married, right?
Yeah.
So yeah, go ask Kevin.
Yeah, 36 years this year, believe it or not. So
Congrats.
that's a
Yeah,
long
that's
time.
awesome.
She's a saint to be able to deal with me for that long.
After 30 or so years, it's a farm and
Yeah.
chickens and no, it's incredible, incredible. One last question here, because I want to end on a rather high note for all of us. So just so we all know now, right? You're going to experience the lows, but we're going to end here now on at least one high note with your most successful investment that you've had. It could be in the stock market, it could be outside the stock market, but just one thing that you've really poured a lot of time, energy, perhaps money into, that has been your greatest investment that has led you to where you are today.
I'll go first. I would say this is not even money wise. I would say in my investment in my health, because if you're not healthy, it's hard for you to work. And I've invested, well, I do a lot of cycling and things like that. So and time as well to work out and try to stay healthy. So that's one of the biggest ones. And of course, just with my 401k IRA, just by having that automated and just over time, really doing nothing but just consistently working. And that's been my key to success there.
Yeah, I need to connect with Joe so he can motivate me on the health side. But I think, for me, none of this works unless you invest in yourself, right? And so, from Joe's perspective is, hey, let's invest in our health. I would also say invest in your value. Decide to take courses, decide to have experiences, work experiences that give you an edge on experiences other people may have, and that would make you more valuable in the marketplace. And the more valuable you are in the marketplace, the more value you receive through compensation. And so it's that compensation that allows us to invest. And so I think what you're hearing from both of us is, make sure you invest in yourself, and then that's what allows all of this to happen. So from my perspective,
it's great. It's great. Certainly the best investment, definitely in yourself. And I know, just as the young buck on the phone call, again, like so many things I'm taking away here, and certainly going to reevaluate my budget with my girlfriend after this call. We're pretty strict on that budget, but no, it's all important things. Again, two masters of the market here with us. Kevin Burgess, go check out his channel, as well as The Average Joe Investor. Go check out Joe's channel in the meantime, because next week we're going to have both of them back on, and we're going to get right into actually crafting out a dividend portfolio, how to do it, what stocks to start to look at, aside from those ETFs that you're going to build your foundation with. and a little bit more questions oriented around picking the right dividend stocks, and is there a right way to go about the whole dividend investment deal. So investors, thank you for joining us here for another Masters of the Market. Joe and Kevin, thank you so much for joining me again here on Masters of the Market. We look forward to having you back on next week for another go round with us. Now, investors, until the next time, we will see you all there.